The objective of Section 2 is to understand the temporary assignments and related deductions, to determine whether entertainment is directly related or associated with the conduct of business, and to be able to explain when business gifts are deductible.
We'll discuss what type of expenses are deductible when Bob is out of town on a temporary assignment. We'll follow along as Bob gets a temporary assignment in Austin, Texas. Due to a strong real estate market in Austin, Texas, one of Bob's mortgage company clients asked him to temporarily move there for an 8-month assignment to perform home appraisals. Since Austin is 3 hours away from Houston, it made sense for Bob to rent a short-term apartment there and just come home on weekends. What is a temporary assignment? This is an assignment away from the area of your tax home that is realistically expected to last for no more than a year and does in fact end at that time. If Bob's client had told him the assignment was expected to last for more than a year, or actually did last more than a year, that would be considered an indefinite assignment rather than a temporary assignment. If Bob had a series of 4-month jobs in Austin that ended up being over 1 year in total, this would also be considered indefinite. What expenses are deductible on a temporary assignment? If your assignment is temporary, then personal living expenses are deductible, such as rent, utilities, and meals, as well as other expenses such as dry cleaning and laundry. Essentially, if you're out of town on a temporary relocation, you are considered to be traveling away from home, so your normal travel expenses are deductible. Meals are still subject to the 50% deduction limit since Bob uses the actual cost method. The idea of duplicate expenses. The general idea behind making temporary living expenses deductible is the recognition that you are incurring duplicate expenses. It is considered unreasonable to have to relocate for a temporary business assignment. But if the job is indefinite, it is considered reasonable to relocate there, so in that case the living expenses would not be deductible. Bob comes home on weekends. If he has to pay for his Austin lodging on weekends, even though he's not there, that would still be deductible. For example, if he rented a motel room by the week or an apartment by the month, the full cost is deductible. His travel to and from Austin is deductible. His meals during the weekend would only be deductible in accordance with normal travel meals restrictions. So his meals while traveling would be deductible, subject to the 50% limit, but his normal meals while at home would not be deductible. What if Bob's project is extended? Since the length of the project affects whether it is treated as temporary or indefinite, what happens if the project is lengthened from 8 months to 14 months? Remember, under 1 year is temporary, over 1 year is indefinite. As long as the initial expectation of 8 months was reasonable, Bob's living expenses are deductible until the time that the expected length changed. So, if at the end of 8 months the expected end date changed, then the expenses for the first 8 months are deductible. But if the expected end date changed after only 3 months, only expenses for the first 3 months are deductible. What if Bob's project is shortened? If Bob's project was expected to last 14 months, but instead only lasted 11 months, then no part of the living expenses is deductible. The entire project is considered indefinite in length, even though it did in fact end in less than 1 year. What if all of Bob's projects are out of town? You must have a tax home in order to ever be considered away from home. If no work is ever done from your tax home, then you have no tax home and no living expense deduction is allowed when you are on a temporary assignment. If Bob always worked on assignments in other cities, then he would not be able to deduct any temporary living expenses. We'll discuss what type of expenses are deductible when Bob is out of town on a temporary assignment. Next, we'll follow Bob as he takes his clients to an Astros baseball game. Every year, Bob gives an afternoon seminar to his best clients, and that evening he takes his clients to an Astros baseball game. Is the game tax-deductible entertainment? To be deductible, entertainment must meet either the directly related test or the associated test. To meet the directly related test, you must show that the main purpose of the entertainment activity was the active conduct of business and that you did engage in business during the entertainment period. Bob had minimal business discussions during the Astros game. In fact, it was too noisy to really have a serious business discussion. The IRS recognizes that certain venues are not conducive to serious business discussions, and the following are presumed to fail the directly related test unless you can show otherwise: sporting events, nightclubs, golf courses, theaters, and hunting, fishing, or skiing trips. If you can show that you did actually engage in substantial business discussion during the entertainment in spite of the distractions, you can deduct the entertainment cost. In this case, though, Bob did not meet the directly related test. The associated test. If you can show that the entertainment precedes or follows a substantial business discussion, you can meet the associated test. The entertainment can be to acquire new business or to cultivate an existing business relationship with clients or referral sources. Bob did appear to meet the associated test. He held a business meeting prior to the baseball game, which was intended to cultivate business relationships with existing clients. We'll discuss what type of expenses are deductible when Bob is out of town on a temporary assignment. Bob wants to buy some nice gifts for his clients to thank them for their business and further nurture their business relationship. Bob decides to buy gifts for his clients. He is considering buying a $125 leather portfolio for each client. Is this gift deductible? Not entirely. There is an annual business gift deduction limit of $25 per recipient per year. This $25 limit has not changed since the inception of the business gift limitation. If this figure seems low, that's because it was established in 1954. In today's dollars, the limit would be $213. If Bob gives each client a $125 portfolio, only $25 per client is deductible. Incidental costs, such as the cost of engraving, gift wrapping, packaging, and mailing the gift, are not included in the $25 limit for customer gift deductions. These incidental costs can be separately deducted. A cost is considered incidental if it does not add substantial value to the gift. What if the gift is promotional? Bob decides to engrave the leather portfolio with his company's name to provide some advertising. Unfortunately, adding your company name to the gift does not change it into an advertising expense. There is an allowance for giving small promotional gifts such as pens and plastic cups. As long as the gift costs under $4 each, your name is clearly and permanently imprinted on it, and there are a number of identical items that you widely distribute. If you meet those criteria, 100% of the cost of these promotional gifts is deductible. But engraving the $125 leather portfolio with the company name does not change the fact that only $25 of the cost is deductible as a business gift. Bob wondered if perhaps both he and his wife gave someone a gift, they would be able to double the $25 limitation to $50. That doesn't work. The limit is $25 for both husband and wife to give a gift to a single person per year. You can't double this gift deduction by including your spouse or business partner as a giver to the same recipient. Under this definition, you and your spouse or you and your business partners are considered one giver. It doesn't even matter if you and your spouse work for different companies and just happen to have a common client. Neither can you double the value by giving $25 gifts to a husband and wife, as the $25 limit applies to recipients and their spouses. Bob decided the easiest thing to do was to drop off a large fruit basket at the company's reception area for the benefit of all the employees. The large basket cost $250. Then he dropped off a small fruit basket for the president, which costs $100. The $25 limit applies only to gifts to individuals. It doesn't apply if you give a gift to the entire company unless the gift is intended for a specific person or group of people within the company. Such company-wide gifts are deductible in any amount as long as they are reasonable. The large basket is a gift to the entire company, so it's not subject to the $25 limit. The gift to the president is a personal gift, and therefore it is subject to the $25 limit. Bob wants a larger gift deduction. He's worried that he is going to appear cheap if he gives a $25 gift to clients who pay him an average of $10,000 per year for his services. He wonders if there is some way to provide a larger tax-deductible benefit to his clients. He could take each client out to a nice dinner. It could be more advantageous and enjoyable to take your client to a $100 dinner and get a $50 write-off than to spend $50 on a gift but only enjoy a $25 deduction.
Bob has 2 tickets to a basketball game which he cannot attend. These tickets have a face value of $90 each. There's a special rule if you provide a client with entertainment tickets, such as tickets to a basketball game. If you don't attend the event with the client, you have the option of treating the tickets as either a gift or as an entertainment expense. Gifts of up to $25 are 100% deductible, while entertainment expenses are only 50% deductible. So with tickets that in total cost less than $50, you get a bigger deduction if you treat them as a gift. If they cost more, treat them as an entertainment expense. In this case, the total cost of two $90 tickets is $180, so the deduction is 50% of 180 or $90. Since $90 is greater than the $25 gift deduction, Bob elects to treat the tickets as an entertainment expense. We have reached the end of Section 2.